So this is a second episode with Adrian Bunter, who's on the board of Employment Hero, and we talk a little bit about some of that, I don't even know how to properly describe it, shit fight that's occurred. But Adrian's also been a long-term member of Sydney Angels, and we talked about some trends.
Yeah, trends like in terms of valuations, but also a lot about tips for founders when pitching, how to think about approaching fundraising and having awareness of the investor perspective, but then also a little bit about technology and some of his views on AI, for example.
Adrian has come from an accounting background, so looks at the detail, but then also comes from the entrepreneurial background and really seeks to understand the business and the business models. He brings a really great cross-section of skill sets and perspectives. So let's get into the episode.
Let's get into it.
Adrian, thanks for joining us. This is the second time we've been able to get together. Really appreciate your time.
Not a problem. Great to be here again. I can't believe it's been almost 5 months since we actually spoke last time around.
Oh, wow. Really? That's fair.
Yeah. Late October.
Far out. Thank you.
Yeah. I can't believe it's almost Easter.
No, it's past Easter.
Easter's gone, Don.
I've got this big novelty calendar in my office that I try and keep everything together on. And my wife came in this morning to put on something for 2025. It's like, can't we just get through 2024, please? So we've got a lot to talk about. This episode, we've agreed we're going to go a little bit into some trends. We're going to have a look at where we're seeing people probably succeed, where people are finding some challenges, and then get into more of the capital raising process, because we just think that's going to be really helpful for entrepreneurs.
Yep.
Before we get there though, seeing as we've got you here, we'd love to just understand, where's Employment Hero v the super funds up to? I think the listeners would find it negligent if we didn't ask you that.
Yeah, look, it's probably safe to say that it's been a pretty interesting time for Employment Hero and the board over recent months. You've covered it a couple of times. People ask us about it quite a lot. I'm happy to talk a little bit about it. Are there any sort of key things you'd like to get a view on?
I guess with some of these issues, it's hard to know each side's perspective, but I guess the perspective here is that Employment Hero is seeking to provide choice and an easy user experience. The super funds are concerned of the pay-to-play side.
Yeah, look, I think that's probably a fair assessment. And I think it's probably safe to say in a lot of cases, it escalated a lot faster than a lot of people thought it was actually going to. And there was lots of responses backwards and forwards. And I think the important thing is Ben spoke out about something that he felt quite strongly about. There was a lot of questions raised by Host Plus for the board. I think I'd like to say, I ultimately support Ben's free right to speech, and he's going to go out and promote and support the vision of Employment Hero. He's a passionate founder. He talks about what he believes in. If he does see something wrong, he's going to actually call that out. And for the listeners who haven't followed, I think Host Plus appeared to take issues with a couple of things. Ben made a claim that Host Plus was against choice of funds in their submission. They stated their belief that they weren't trying to stop people from choosing super funds. Personally, I'm not sure if anybody actually read their proposed legislation would have the same view as Host Plus. I certainly didn't. Ben certainly didn't. I think they seem to take a bigger issue with Ben threw out a $1 million challenge to the Host Plus CEO, really looking to prove the effectiveness of the Employment Hero platform versus their other advertising channels, which includes a lot of sports teams, sponsorships. If you go back and look at what Employment Hero is trying to do, it's trying to make employment better for everybody. And it's really about improving the workflows in that platform. So Ben spoke out about that. At the end of those backwards and forwards, it ultimately resulted in Host Plus writing a letter with a range of threats and effectively wanting the board, questioning the board when they should be sacking Ben. In some respects, arguably effectively cancelling someone who was challenging them. So I think some of it's more of an indictment on Host Plus, not on Ben Thompson. Most people stick their head in the sand when it comes to technology and doing things better. History usually proves them wrong. If you go back to the early 1800s, English textile workers opposed use of machines to actually improve cost savings, and they destroyed the machines. They were called Luddites. If you move forward to today, we're in a massive period of digital and AI evolution. It would seem that Host Plus wants to ban the digital channels, not just during onboarding, but throughout the process. It seems that they're afraid of possible competition that the digital world offers. They prefer to destroy that digital employment revolution because they don't understand it rather than embrace it. As I said earlier, Employment Hero wants to make employment easier and more valuable for everyone. The suggestion that you want to break an onboarding workflow and send employees and employers off to the tax office to do a process and then come back on is a terrible outcome. It adds friction, it adds complications to employment. And the only people who benefit from something like that are large super funds with lots of default agreements, people like Host Plus, because ultimately people decide they couldn't be bothered dealing with the ATO separately, and they'll just go into their employer's default funds.
And one of the just on that, one of the issues I think from the government's point of view seems to be, correct me if I'm wrong, people not accumulating lots of different opened funds. But my understanding is that that's not really an issue.
Yeah, that's right. And a lot of people make claims around the platform without understanding how the platform actually works. So it actually starts by trying to show people an existing fund they actually have. And then what it says, if we can't find one, and interestingly, Employment Hero's platform can do it better and actually tap into every single fund and have actually requested the ability to do so, but the laws don't allow them to actually do that. Trying to make it better can't actually make it better because of the rules. It then goes on and says, if you didn't find the fund, you've got one, you can go and pick from any particular fund that exists in Australia and actually choose that as your fund. And if you then don't do that, you can then go and choose a partner fund, which is somebody who's clearly identified as a partner fund, who is an advertiser with Employment Hero. And then we actually disclose that they're an advertiser and disclose exactly how much they're paying to be in that particular position. But the starting position is go to default, go to staples, go to any other fund, and then go to partner fund. There would be an ability to then also do a stapling. So once you've chosen a fund, to go and actually have a look and consolidate all your funds to that one once you've made a choice. But again, the rules don't actually let you do that. Classic example of where technology could make a system better and actually more aligned with what the government's trying to do, but the rules are not allowing that. And then you have some industry participants arguably fighting very strongly against that.
Yeah. Do you have a read of where it's going to end up or land in the end?
Oh, look, it's hard to know. I think super choice is important for lots of people. There were definitely some issues with some other platforms that were arguably promoting funds that they had a financial interest in. That actually stopped a while ago. So that's actually no longer an issue. I do think people should be embracing technology. I think ultimately the government realizes if they want to bring in things like payday super, which means employees are going to get paid on their super on the same day they get paid, you have to have really good systems and processes to enable that to happen. If you want to wait 28 days for somebody to go and choose a fund and go backwards and forwards, multiple paydays have actually happened in that time frame, and you just increase your level of complexity in the system.
And so do you think that's where we're heading? You do a day's work, you get paid a day's work?
Yeah, look, I think the government's very clear that they want to avoid the proliferation of funds and duplicate fees and that kind of stuff. And that's 100% the right approach around it. And I think the use of the platforms can actually do that better. I think actually more information. People are very apathetic when it comes to superannuation. They very rarely think about it. It's very much a set and forget. And that's actually a problem. You want to actually have people engaging more and being educated more around super. And the most times that people actually think about those things is when they change their job, or they go on maternity leave, or they get a major promotion. There are these certain things that happen in life when you actually do think about super, and the platforms that they engage with on a daily, weekly basis is the best place to actually do that.
Some people that I've read online have talked about, well, are people qualified to make these decisions alone? But if the information is there and there's a proliferation of digital advice coming, the whole world is ending digital. And so if you're going to start a new employer, to be able to have a beautiful user experience, to come in and be able to have informed decision making.
Yeah, I think that's right. So you've got to have those information sources. There is a definitive source, which is the government website, which actually does all the ratings. Employment Hero pushes people back to that. It doesn't actually give personalized advice around it. It does have an AFSL authorization to give general advice to actually do that introduction side of things, but it pushes people back to that government database. There are lots of places to go out and benchmark super. A lot of things that people don't realize is that some of those ones are effectively pay to play as well. So you only get ranked and sorted on the system if you're paying to be a part of the review process. So you can then go and put that logo on your website to say we were a top 10 ranked fund, but it's not a top 10 ranked fund of every single fund. It's only a top 10 ranked fund of all the funds who actually, pay a fee.
Super interesting. The other part of this for me is, as a founder, it's challenging sometimes to know what battles are worth fighting and when to go after making a statement, particularly in an ecosystem or in a sector like this, and particularly when you're up against big incumbents. What's your kind of roll through this as an investor, and how do you guide Ben to make these decisions?
I think you've got to sit back and look at the overarching principle about what the business is trying to do and actually ask yourself the questions, what's actually right? And in a lot of cases, too many people scared to speak out because of the consequences of what that might be. And if Employment Hero had been a fraction of the size of where it was, would Ben have had the confidence to actually step out and make those comments? Probably not. But it's now sufficiently large enough that it can actually weather the storm, the brutal storm that actually came as a result of speaking out. The super revenues are actually a relatively small percentage, actually tiny percentage, single digit percentage of the revenues of the business. So it's not like it's reliant on it is a genuine value add. And Ben and the management team made the call that the alternative that was being proposed would be a terrible outcome and a terrible experience when it came to product. We would actually have to make the product worse and spend development resources making the product worse for employers and worse for employees. That's just wrong.
You may not actually want to comment on this, but sometimes other investors can get caught in the middle, like an air tree. How have you found others that are part in both camps, and how have you found their support, or how have they handled it?
Yeah, I think Airtree gets put in an extremely difficult position in this scenario where they've got one of their investors in their fund, writing to them and asking them to influence the board and pass them on to the board in this regard. And I think actually Airtree have done a fantastic job, weaving the fine line between those balancing responsibilities that they have to support founders, but also responsibility to their investors. They ultimately invested in Employment Hero because they believe it's going to be a great investment outcome for their investors. And they believe in the thesis of what Employment Hero is trying to offer and the solution it's putting into market and doing well in that offering.
We're going to be interested to see how it plays out. Listeners of this podcast know that we often talk about integration and disintegration and constructive energy and destructive energy. And all I know is that an ecosystem needs as much constructive energy as possible. And just hoping that the parties can find a way through it. I know that you'll be able to provide a good guiding hand there. But one of the things we're seeing, though, is a trend towards investors probably getting a little more hands-on rather than being hands-off. Where are you seeing that hands-on, hands-off continuum?
Sorry, in regard to this specific issue or just generally?
Just generally looking at the ecosystem broadly.
Yeah, I think it's... An investor can provide dollars, right? But dollars in some respects are a commodity. The value add that they can provide in guidance and introductions and becoming more hands-on and solving problems, I think is where investors can add a huge amount of value beyond just the dollars. You do see some investors who potentially want to get too hands-on. They forget that they're actually enablers and investors. They're not the actual operators of the business. I think they have great insights to provide, but they're not in the day-to-day of the business. And the business ultimately needs to stand on its own 2 feet. Now, obviously, the earlier the business is, the less resources and capabilities it has. So therefore, it will lean on its investors more. I know on some of the very early stage companies I work with, they'll definitely do things that are more hands-on as an investor or as a board member than what you ordinarily would in that sort of normal non-exec type role or passive investor type role.
I'm learning is that at best, I think the saying is VCs should be able to say they were in the room and probably no more than that. If a founder needs more than networks or some relationships or some frameworks or some support, if VCs think they're going to get in and start driving the business, I just think that is, or even angel investors, if you've got to drive the business outcomes, I think you're in the wrong investment.
Oh, I think that's right. You shouldn't, at the earlier stages, you're backing the team. Like the whole point why you're putting your dollars in is you're actually backing the team to actually do it. You think they are super smart people, able to solve the problems they come across. Yes, everybody needs help from time to time. Even the most experienced people need help on a whole wide range of things. But I think it's a very fine line.
I think it is a bit of a watch out for ex-operators in VC. Like it's a watch out. When, your natural default state, you can, like the story I tell myself is I can see how this will play out. I can see the pattern. I can see where this is heading. Therefore I should jump in. But it's actually having that discipline of trusting the founder and being there as guidance and support and spending time with the founder, but not actually leaping in and trying to tell them a way to do something, which even though from my experience of N=1 might be true in my head, might not actually be true. And you've got to back the founder that's actually in the driver's seat.
And Aaron, I think that's right. Like, I think most people give advice, especially if they're coming from an operator perspective from the N=1 scenario. So they're giving the advice in the context of what worked for them. And it was a specific situation at a specific time and a specific set of scenarios. And the likelihood of that applying in the same way to the person they're giving the advice to is exceptionally low. And I see lots of founders get advice from people, from other founders. And in my view, again, it's one opinion, my view, it's actually bad advice because it doesn't take into account all those other scenarios and factors that people need to be thinking about. So you need to be able to, a founder needs to be able to take advice from multiple sources, filter it for the context of the background of that advice, but also their own specific situation, and then make a decision themselves based on the best available information they have at the time.
Do you think that whether it's in VC or angel, do you see a future where a VC becomes a bit more commoditized and perhaps the differentiator of value-added support is almost becomes an essential element, like an essential element of differentiation?
I don't know. I think to become too specialized and too much value, you actually need to be very large and have lots of resources around it. I think some of the large funds in Australia are starting to definitely have the capabilities of delivering a lot more value add and support. But I think the smaller the fund, the harder that actually becomes to do, right? So then you're very heavily reliant on a small group of people to do the substantial value add. And arguably you need people with some grey hairs who have been around the block a few times and actually got some experience to do it. And it's going to take decades for us to, if people benchmark where the US market is, so we are decades behind that market because we started decades later than that market. So you can only catch up so quickly.
And I get a bit nervous that some of the value add services that we're seeing come with a cost. And so then I believe generally people always get into things with the right intention. But if you're a VC that started to hire people to deliver certain things, and then your revenue source is coming from those early stage businesses, at a certain point, it's hard to say, okay, I'm not going to charge for any of these aspects. And then before you know it, you're not aligned. So I get a bit nervous with that.
Yeah, I think that's right. I think if you're giving it completely for free as part of the investment, I think that's a much easier proposition around it. But when you start becoming a service provider, but then again, we've all got investments where the founder says, do you know someone who can do this? And it's quite often a common question. So if you can say, actually, I can help solve that and create a little service which is cost effective, efficient, and I can highly recommend because you're actually delivering it, I think, that's okay. But you need to find a line between at what point do you become conflicted around that. And you still got to remember that a business still needs to stand on its own 2 feet ultimately. So there has to be this transition period.
Yeah. We've seen a big difference in the beginning of 2024 than the ending of 23. And we spoke last time at the latter part of 23, where I think it'd be fair to say that vals were still going down. It was a bit of a depressed capital market. From where we're sitting, we've had a bit of a springboard, but what are you seeing in terms of that vibe?
I think at the earliest, at the pre-seed stage, it probably hasn't yet been a large amount of movement. But I also think that's partially because they didn't go down as much as some of the later stage investments. So didn't drop as much, therefore not going to bounce as much. I still think there's definitely a significant uncertainty on the market around economy and rates. I think people are still looking for that guidance to say, no, that's it. There's definitely no more rate increases and the next rate movement is going to be down. There might be some delays on when that is, but I think there was a large cohort of economists who were saying there's going to be rate decreases back end of this year or even mid this year. I think the likelihood of mid this year seems pretty remote, maybe one back end of the year, who knows? But I think people are still looking for that kind of guidance before they really turn risk on again, so to speak.
How do you know an economist is wrong?
They're talking?
Yeah.
I think the other thing we're seeing, Adrian, a lot of the founders coming through now, they've definitely got the message of it's the era of resourcefulness, of the resources, and the business fundamentals and metrics are looking healthier. Are you seeing something similar?
Yeah, I think that's right. I think people have realized the concept of cheap, easy, anyone's going to get money. I think there was a hope that people thought it was going to come back at some point in time, but I think everyone's realized, no, it's not going to come back again. And so there's definitely a much more increased level of focus on getting to profitability or not being wasteful in expenditure. That being said, I don't think, in the companies that I've been involved in sport, I've never seen wasteful amounts of expenditure. You can always tighten the belt, I think, after things have been going well, but I think they've been quite good and they've been quite disciplined in that regard.
The other data point we've been seeing is just around the number of new angels coming into the investment landscape and how that's been declining, particularly, I think it was the last. And so there was, the charts show this flood of new angels coming in at the peak of that 21 cycle and now diminishing off. Do you think that'll return back? And for those investors that came in at that time and got maybe a little bit burnt in some of those valuations, any advice for them?
I think if they came in that time, and I think what drove more investors coming into that space at that time was ultra low interest rates, where your alternative was that you could put your money in the bank and get 0.1% or get zero. Anything that was better than that looked positive. So if you're in a sort of a high growth, people were reading about these massive valuation increases. So I think that definitely drew a group of people into the market. If you got carried away and as a result of that paid higher prices, I think you're going to experience some pain. If you were still relatively disciplined and knew that you had to have a highly diversified portfolio because it's very difficult to pick winners, I think those people didn't suffer as badly. And I think it's a long, slow, steady game if you want to be an angel investor. Like 10 years plus if you got it right.
When I look at Brisbane Angels, those that said, I'm allocating to this asset class roughly this amount of dollars each year, and it's just part of the process, they may well have some that have caused pain. But the people that rushed in and went, I'm going to deploy all my capital in this period of time. If I don't board the rocket ship, I'm not going to get the next unicorn.
With the angel asset class, is when you first come in and get involved in it, everything looks fantastic. Everything's exciting, right? Founders who are so passionate about what they're doing, and it's hard to scratch beneath the surface and actually get into the nitty gritty of those things. And you want to support people. People get into it. Yes, they want to make money, but they actually want to help people. So they find these people that they like, and they do start doing some DD. And then I see people that feel guilty to say no. So they say yes, but their gut tells them they shouldn't say yes, but they do.
Yeah.
And they're the ones that are doing, and they get fearful of missing out on the deal. But what they don't realize is that there are hundreds of opportunities. There are thousands of companies out there, and they're always raising at some point in time.
It was interesting catching up with the former chief entrepreneur of South Australia, Adrian Bunter, and he was talking about activating new angels in South Australia. And he said they often come in because they want the public story to tell their mates of the companies that they've backed and that they're in the next Canberra. But when there's a mistake, if someone's made a mistake, I want to have made the mistake that everyone else made, not the mistake that no one else made. And I think it was an interesting insight, the fact that people are coming in a sense of FOMO and wanting the story, but not actually doing the work to understand the investment thesis and those other elements.
I got a lucky break when I was 18 and Dad backed me into buying a business. And I remember there was a period of time where it almost fell over, and I was like, I want this to happen. It needs to happen. I would be devastated it didn't happen. And then about 2 years into running that business and the realities of running a business and all of the shit, another business came up. I was like, fuck that. I don't want another load of stuff. And I think there's some similarities with angels that if they are really excited for their first ones and then it doesn't go to plan, and spoiler alert for listeners, it never goes to plan. Even the unicorn you see, at some point, there are multiple things that didn't go to plan. And then as long as you don't burn yourself out, you then are no longer as FOMO, as an impatient as you were for the first investments. And then you just take a chill pill a little bit. That's my experience, at least.
Like it never goes to, so I do say it never goes to plan. I've only ever seen or know of one investment, and I'm sure there are others out there, where it absolutely did go to plan and they absolutely didn't need to ever raise capital again. And they became a highly successful, profitable business. But that's one out of, I don't know how many thousands I've seen in the last 20 years.
Adrian, what do you see in terms of technology? We're having a conversation at the moment around pure play SaaS and how defensible that is in a world where AI, it feels like AI, and it can generate source code pretty well at the moment, and that's only going to improve, and a lot of sectors are becoming advertised. And so we're starting to build a bit of a thesis around software wrapped in plastic and light hardware plays that enable SaaS to do more. But what's your sort of view on this?
So I think about this more about what has come back, what's the problem someone's trying to solve, right? Again, I'm looking at their very earliest stage. And so the application of technology, and I think you're asking about, is SaaS still there? I think SaaS is still absolutely there. I think AI is a really interesting thing that comes in over the top. And in my day job, I'm an M&A corporate advisor at Modus Partners, right? So I specialize in M&A for technology companies. I've focused on that area for 15 years. 15 years ago, there weren't many people who specialized or focused on trying to do technology companies. Today, every single business is fundamentally a technology company. If they're not a direct technology company, they use and apply technology in their business to be more efficient and more effective. I think AI is going to be a similar kind of thing in a lot of cases. Any kind of professional services, any kind of service-based offering that's not necessarily involving an actual physical product is going to have some kind of application of AI into it. And the businesses who are going to leverage that the most, I think, are the ones who have got an existing offering, the existing proprietary data set, or they're close to the customer because they've got the customer. It's an add-on to it. We've all seen plenty of pictures for AI-related products that is literally a single feature that could be plugged into another product. And it's great in theory, and no one's doing it at the time. But in about 6 months' time, every other company will be doing that same stuff. I'm actually quite excited by the whole AI application, especially when the coding side of things, because I think it enables entrepreneurs who are not necessarily as technically inclined to code something up and actually use the tools to do it and effectively almost have an AI co-founder, so to speak, in their business. I think how that plays out, I got no idea though, like in terms of trying to pick the winners.
I think to your point, we had Vu Tran, one of the founders of Go1, at my place recently, and we were talking about a similar topic around SaaS, but he made the point that a lot of founders still don't quite get is it a problem to be solved? And he's a GP 2 days a week whilst co-founding a unicorn. And he says as a GP, he sends 20 faxes a shift. People look at that and say, fax in this day and age, that's ridiculous. I'm going to solve that problem. But for him, it takes 2 seconds or he hands it off to somebody else. The counterparty is built on fax. You've got this whole industry that's still interconnected. And so if you wanted to solve that problem, you've actually got to solve a whole lot of other things, but it's just not a problem. And I think what's going to be interesting is that AI is actually going to trip a few people up where they can more easily go and solve problems that turn out not to be problems worth solving.
Yeah, I think that's right. The hardest thing when people create a new problem is like quite often the problem is there, but the change management process about how you actually get people to stop doing what they were doing before, where they've got this natural habit which has been built up over however many years or decades in the case of sending faxes, where everybody else is actually used to operating that exact same way. That's a really hard change to make. And it might be the most brilliant solution in the world. And it's clearly a problem, but it's actually not a big enough problem amongst all the other things for people to change.
And what else do you look for? Like to navigate, to make an assessment that a SaaS product isn't highly commoditized very quickly. You mentioned a couple of things in there. Who owns the customer was one he references. And it's not just a feature that someone else in the stack is a better natural owner of, but what are you looking for at the stage you're investing to give those signals?
Again, I think it comes down to what the problem is being solved and the framework for that. But it's how are they going to go to market around it? Do they actually do they know, have they actually spoken to customers and deeply understand the solution they're building solves the problem they've got? How are they going to get that out there? Are they actually a smart enough team? Can they actually explain it and get other people to join them as part of the journey, whether it'll be a co-founder or staff members? I'm trying to solve for the scenario that I know where life is going to be hard, shit's going to get bad, and the entrepreneur needs to keep on going through in a scenario where an ordinary person would have given up. I think that resilience and borderline stubbornness is actually really important when it comes to founders.
Willing to speak out when things are going a bit sideways. And if we think of founders who've found companies with ideas and problems to solve, when they're ready to go and find capital, there's a start that they do with their search. And we were in South Start recently and talking to a small fund out of Sydney. And by this stage, we'd had a few drinks, so they were willing to share a few things. And they were going, fuck, it is so hard. We're on the coattails of others. They go to the bigger brands. Nobody's coming directly to us for deals. We're fighting for scraps. And so from a either personal or Sydney Angels point of view, how do you get in that stream of ensuring that the deals come across your table?
That's a really interesting question because it's actually something we do talk a bit about at Sydney Angels, because I think we all acknowledge we probably don't do it well enough. We necessarily don't get out and market, and the big brands actually do a really good job at getting out there, and they say they get the best deals. I really struggle with what is the best deal, right? Because you don't know if you've had the best deal until it's successful 5-10 years down the track. In 10 years, I think in 5 years, you've got a good view if it's got potential to be one of the best deals that's actually out there. You just got to get out and talk to people and be on the radar. I still am astonished though when I meet someone who's a Sydney-based founder who's looking to raise capital and they've never heard of Sydney Angels. If you jump on Google and you Google Angel Investor Sydney, you'll generally find the Sydney Angels website in the top, 2 or 3 links.
Well, not even Sydney. I Googled it the other day because I wanted to see who was coming up in the ecosystem, and you're still on the first page.
Yeah. But what it goes to show you though, that there are entrepreneurs that are in different segments and different sectors who are not experienced around it. So there's an entrepreneur who's been heavily involved. They've been involved in a tech startup in the past. They're involved in the ecosystem. They actually have a network of people who can get introductions. Then you have a founder who is potentially a deep expert in the segment that they're in, solving a problem, but they're not your traditional founder. And to be honest, I think you stumble across them somehow. The same way any company that's highly successful, one key criteria that they need to have at some point in time is they need to be in the right place at the right time, and they have luck. I think that also goes on the same for investors, right place, right time, and they have to have some luck. We had a recent B2B SaaS one that Sydney Angels has invested in. Nobody's aware of it because it actually hasn't announced that they've even done a round yet. And we did that a bit over 12 months ago, and they just got on with building the product. They got referred. I think one of our members met them, had a couple of conversations and said, oh, yeah, you should think about this. That other member and myself had a couple of conversations, helped them out with just some broad thinking about it. They ultimately applied, and Sydney Angels co-led the round with some actually industry people who got involved with that business. And it's B2B, SME through to enterprise SaaS in a super, super boring industry that I think will do fantastically well and potentially be one of the best investments I've ever done out of Sydney Angels. And they're not going to need huge amounts of capital around it. So they're probably not right for some of the larger VC funds. Or if they had have been, they would have taken so much more money that they probably would have been inefficient, and the founder probably would have been diluted more than what they needed to be.
That's an interesting. I spend most of my Sunday searching in for Gold Coast founders that were a third or more degree of connection away from it. And I actually found a lot of good founders there that are not connected into the ecosystem. There's one in particular that Don, they're going to send through their deck. They're actually looking to raise that would not have otherwise come across our desk or even locally. They're actually will. But Adrian, I'm curious, with Sydney Angels, do you do much active outbound search?
We probably don't. Actually, before we don't do much outbound search, we try to do some articles and some LinkedIn posts around it. We also do speak at some events. We'll go and do things with the universities and talk to, again, but it's around the entrepreneur part of the university around it. I actually do a talk on how to value a startup, which is targeted at both investors and at founders to think about how they should do it. And that sort of gets us into a certain network. We've also do some just general education stuff around term sheets. But again, you still tend to be hitting more towards people who are involved in the ecosystem. So I think the broader press and PR, and then telling people what you've actually been doing as the intro that says, oh, by the way, you should just go and have a chat to that person. They might be able to help you out.
Brisbane Angels finds anytime there's like an announcement of an exit or an investment, there's a little spree. Because was Sydney in Clipchamp?
No, Sydney wasn't in Clipchamp. Oh. So I think that's one of obviously Brisbane Angels' fantastic deals.
And that momentum drives momentum to a certain extent with some of these things. Once you get your exits and your success stories, that's what sort of helps a bit.
Yeah, Sydney, again, need to publicise it more, but if it continues on the where it is, it effectively will be hopefully soon announcing that it's backed its first unicorn. Now, it ultimately is a publicly listed company now. So Clarity Pharmaceuticals, which first got invested in, it's got a circa 800 mil market cap, just raised $110 million, doing some fantastic things. And Sydney Angels backed in the first round, forward and multiple rounds through that. That does well. When Instacluster exited Sydney Angels in the first round of that, that was another spectacular outcome that come through. And you're right. I think when you announce those, you do get a bit of a flurry. People don't realize, oh, I didn't realize you invested in that, or you do that kind of stuff. And that sort of brings investors in, but it also brings founders in as well.
And to your point of Australia being 2 decades behind the US, if you look at the US environment and the way angel groups and investment groups work, I think that's probably where we're going to go. And if you want to survive and stand out, you've got to beat your chest every now and then, which Australians aren't all that comfortable doing, whereas Americans will go to the opening of an envelope.
And I think there's some awesome stuff happening in Australia too around the angel sector. Aussie Angels creating sort of the ability for people to enter with much smaller amounts of checks is actually really good. It encourages and enables that diversification of that investment portfolio. And you've got a lead angel that's doing some work, but you don't necessarily get the full access to a bigger network where people are happy to roll up their sleeves because they put more meaningful investment amounts to work around that. I think that the power of investing with other people is fantastic. I've got a certain skill base. There's a whole lot of stuff I can't do. And I get comfort in working with other people who have actually done that, who can do that better than I can.
Yeah, I love in the BA group being, this is a particular issue. I know X, Y, and Z, get on the call. And to your earlier point, yes, there's the returns profile, but these are people that are seeking to actually add value, find a community. And year after year, the people that are truly like seeking to help are the ones that seem to stay. People that came for a quick return that either don't have the value to add or aren't interested in that, they don't last.
Are the angel groups competing more and more with VCs as well? I put up with a group of VCs the other day, and one of them pitched themselves as pre-seed through to Series C. And it just seems like every fund is becoming earlier and earlier. But are you seeing deal flow being diverted?
Aaron, I think it's hard to say about competition around it. I don't genuinely think many VCs properly do pre-seed. I think they say they do pre-seed and they want to see the deals and have the opportunity to do it. But if you actually look at the nature and construct of the funds, it becomes very difficult to do pre-seed. I remember, I can't remember which one it was, but one of the larger VCs had one of their associates did a post about doing a large amount of pre-seed investments and talked about a $3 million pre-seed investment that they did. And my response was, that's not a pre-seed investment. Pre-seed, it's not family and friends, but it's that next level.
Yeah, it's 300 grand.
You know, it's $300,000 to $500,000 is just a pre-seed rounds, not $3 million. But they want to do it. They want to have the opportunity to do it, but I don't see them as real competition at that particular level. I think it's too hard. It takes 10 plus years for a pre-seed investment to get to maturity. And unless they happen to do it in the very, very first year of their fund, it becomes difficult when you're trying to run a 10-year fund to do an investment that's going to take at least 10 years to mature, and you might be doing it in year 3 or 4.
But that's where pre-seed can be a little bit confusing, and that like founder comes from the industry with 10 contracts in the bag, a prototype sorted, a team ready to roll, a history of delivery. That's very different to person not from the industry, still with an idea, no prototype. Okay, the revenue profile looks pre-seed, but they're two very different things.
Go back 10 years ago, there wasn't a thing called pre-seed. Like we've created this new, we've got pre-seed extensions, seed extensions, Series A plus, Series A. People just make it up.
In your view, is that the investors that are trying to create a box? Did the founders come up with that? Is that what the need to label all of that? Is that just humans being humans, or is there actual some science to it?
I don't know. I'm not sure there's any explicit science behind it, right? Because I think it's actually harmful to put it into a bucket, because if you say you're pre-seed and you're not pre-seed, you start going to the wrong people around. I think people should be saying, this is the broad stage we're at. Here's how much money we want to raise, and go from there.
And the word extension, I don't know about you, but if I see extension on it, what I see is the things we said we were going to do, we haven't done yet, and we want more money.
You're right. But to a certain extent, I don't have an explicit problem with that, right? Because go back to the earlier comment where we say things don't go to plan. It always goes wrong. So that entrepreneur raises the amount of money that they think they're going to get to on a whole range of assumptions, and it doesn't deliver what they thought it was going to deliver. And they're not ready necessarily for that next round.
True.
So they have to do something that sits in between. It sits in between.
As long as they tried to do the thing that they said they were going to do, I'm cool with that. If we've run out of money before doing the thing that we said we're going to do, I've got a little bit of a challenge with that because that's not what we signed up for. And we did mention a little bit before with AI, but how are you approaching AI specific startups? Are you separating them out and say, okay, this is an AI startup and therefore needs a certain kind of framework, or how are you approaching that space?
Again, I think I don't come at it from it's using AI. I come at it from the problem and then the solution. If they're happy to be using AI as part of it, then that's fine. But if someone who's almost like pitching it because it's AI, because it's the new sexy thing, it's almost like you get red flag alerts come up right from the get go.
You get negative.
Yeah, correct. It's the AI enabled blockchain that does, it's like cross. Yeah. So I think I'm more looking for where can AI actually enhance the business as opposed to it being an AI business. Because I think you're going to roll forward 5 and 10 years time and every single business is going to use components of AI in it. And sometimes they won't even know they're using AI because it just happens in the background.
A lot of stuff we're seeing, the front end doesn't look AI, and then you do some stuff with it and then it's, hang on a minute, this is clearly ChatGPT that is just plugged into it. And I think those days are numbered.
Yeah. And if that business has got an interesting proprietary network or other stuff and they're close to the customer and they've got other insights, because I think there will be times where you shouldn't necessarily go and build your own AI system. You should just plug into them. And if you plug in right, the benefit of that is when Claude becomes better than ChatGPT, you can just switch your back end to Claude. Like you don't need to know which system it's using. You just want to use the best system.
That's a good point. What about your existing portfolio, like helping them navigate how they should be looking at AI to improve what they're doing or to change what they're doing? How are you helping them answer those questions?
I think it's asking the questions around where can you use it? How can you apply it? And I think in a lot of cases where they're actually coding from a tech perspective, just using Copilot tools, etc., accelerates development. Either they can do a lot more with the same people, or they can do the same amount with less people. So there's a cost efficiency that comes into it as well. But most people tend to be choosing to do more with the same resources. And then I think it's about asking questions about where could you use AI to oversee this? Because you've got a whole range of proprietary data and insights that you've built up over many years that others don't actually have.
And what about from Sydney Angel's point of view? Are you looking at AI tools for any of your systems, reviewing pitch decks that are coming in or anything like that?
We actually have, funnily, if we haven't specifically, and the Sydney Angels process focuses less on the actual pitch deck when it comes in. So we use Gust as the system for the application.
Yeah.
It spits out a sort of a 2-pager on it. It's purely text. It's actually hard to answer it properly because there's actually character limitations in each of the sections. And one of the things that we've found through that process is we actually think it's a more balanced process as well. We find we actually get more female entrepreneurs getting through the process and have a higher propensity to get through into the pitching the initial process and then through to receiving investment. So Sydney Angels has always invested in about somewhere between sort of 20 and 25% female entrepreneurs, which is far in excess of the normal numbers that people talk about. And when we ask ourselves the question is, why is that? It's because there's no pictures, there's no images, and the management team is this small little box which talks a little bit about experience and that stuff. And quite often when you're looking at it, you're not even really looking at the names. You're just broadly looking at their experience and what they bring to the table. So that subconscious bias doesn't get there because you actually don't know the gender of the person at all.
Yeah, that's a good point. With our system, so we have founders apply through the website and then it pushes a notification through to our Slack and on email. And it's often not until we're on a pitch call that I actually first have any understanding of who the founder is. It's demographical information.
We haven't banned the pitch deck, but we are trying more and more to keep the pitch deck well away because 90% of the stuff that we actually need never resides in the bloody pitch deck. And what we're trying to do now is actually give them a go-to-market canvas and say, if you could please fill this out, then we understand what level of maturity they're at with their lead generation and their sales and their business model.
We also don't say don't do a pitch deck because Gus will say if you've got a pitch deck, upload it, and a lot of people will do it. But the sort of the core decision, and I will from time to time, if I see something interesting, thinking, oh, this is interesting, I'd like to learn a little bit more about it. I will go and see if they've got a pitch deck on the system. But I would say 95% of my interest level just comes purely from the words on the page.
So with Gust soon to start charging, are you guys staying on Gust?
Yep, here we are.
Yeah. It's been something that we've discussed internally. It was always going to come, I think.
I look at things right. I mean, you may recall we used to pay for Gust years and years ago, and then they stopped charging for it.
I didn't know.
And I think as a result, they obviously had less development, less resources, and Gust was a great tool at the start. They made some improvements, and then it didn't really change much at all for quite a number of years.
So where are you seeing founders get things really right at the moment?
I don't know. That's actually quite a hard one, because I think for every founder getting something really right, there's another founder getting that exact same thing completely wrong as well. So I think being a founder is super hard, right? The world is full of problems, and that's what they're actually trying to solve. The best founders who get it right the most are the ones who are super passionate about what they're doing, know the space explicitly around that, and have got a vision and bring people along with them. You have conversations with them, you get filled with confidence around it. Not sure if we talked about it last time, but I did a LinkedIn post around this. So one of the things that I look for when I have a conversation with a founder is I come away more energized at the end of the conversation rather than just so around it. Like, you want to be excited by it. If you come away with that every single time you have a conversation with them, you get fired up. That's a good sign.
Yeah, I like that.
Yes. What about the other way? Any pattern you're seeing founders commonly get wrong or struggle with?
Again, it's almost similar-ish in some respects, but I think there probably are some areas that founders are more broadly weaker at. I think one of the areas, especially the early stages, is capital raising, because 9 times out of 10, if you've invested, they've only ever done it once and they don't have a lot of experience in it. It's not something that people do a lot of times, unless Don's earlier comment, you're doing your first round and extension and extension. But it's hard, right? And then they get advice from people who have also only ever done it once. And that advice is not couched in, this is my specific situation, this is my scenario, this is my circumstances, this is what the economy was like at the time, and this is the overall trends that were happening. Like, you lose all of that kind of context, and somebody just tries to replicate what someone else did and it didn't work and they wonder why. So I think thinking through that stuff about understanding how investors think more is what founders don't necessarily do as well as what they could.
Adrian and I are on a common board with VenueNow, Jake and Dave, the founders there. But Jake,
right?
Pardon?
I didn't realize Adrian was on the board with you.
Yeah, and Les from EVP. But Adrian, I don't know if I told you, but many years ago when Jake was doing one of his rounds, he couldn't get to Rockhampton for the angel meeting. So I said to Jake, "Don't worry, buddy. I've pitched for money many times. I see pitches all the time. I'll go up and do it for you." And like, after the pitch, I fucked it totally, but I got torn to strips, and it was just a really good reminder and an empathy developed that even just doing a pitch is actually really hard, and then being grilled by investors. And what I didn't do is I didn't cater to the room. I didn't understand what the investors were looking for. I didn't actually proactively answer the questions. And part of the problem is being a board member, I was just so close to the situation. I just lost a lot of objectivity. But where do you see some of the common things that founders get wrong in pitching for investment, and what are some of the improvements they could do?
Oh, I think that's a really interesting insight, Don, around it, because pitching is super, super hard, right? And to prepare for it, and it's got to, when they're pitching, it's got to be like flow naturally enough that it feels natural, but it also can't feel too rehearsed, which is a really fine line around it. I think for a founder that's been pitching a lot of times, the energy levels are really important to check, because when you've just delivered the same pitch 4 times in a day and you've forgotten, did I say this to this person or who will it is? I think that's super hard, and being direct and answering the questions around it. And I think putting yourselves in the shoes of the investor, what's the investor actually looking for? A founder has rose-colored glasses, always have, always will. In fact, if they didn't, you would never back them. So they actually have to start from that position, and everybody knows it. But I think they also think that things are going to be much easier than they are. They don't actually necessarily counter for the what if this happens or what if that happens around it. I think that where founders often don't do themselves appropriate justice is sometimes being across just some of the detail and the numbers around, especially around if they've launched and they've got unit economics around it, like just understanding some of those really basic things. I actually think some investors don't do it well as well. I'm probably added advantage because of my accounting background around that. So to take it for granted and some of those things come naturally to me, but I think it's hard for founders to do that. And the minute they start floundering and can't answer questions on stuff
it's all over.
Yeah.
I'd hate it when I ask what I think is actually a relatively straightforward question and the founder says, oh, that's an interesting question. I haven't thought about that. Like I should never be able to ask a question that hasn't been thought of. Like a founder should go through all the Q&A of all the possible questions that somebody might ask, put the black hat on and say, why wouldn't you invest in this? What are all the reasons why someone should not invest in this deal?
It's a really good point. You said in there, a tip was for founders to understand the investor's perspective more. How do they go about doing that? Is it just spending more time with investors? Any tips for founders not have that lens yet?
I think it's talking to founders. I think listening to podcasts is a wonderful way to think about how investors think about things. Like your podcast, think like 20-minute VC. There's a podcast in the US called The Pitch, which is almost like a quasi Dragon's Den type thing, but more friendly and more realistic. And just seeing how investors ask questions, the kind of things they're interested in, listening to that stuff, I think is actually quite useful. And because there's so much content out there, you shouldn't need to spend that much time. Go for a walk, listen to a podcast and learn and focus on the areas that you want to learn about.
I think there's also some confusion in that they see some VCs going really early and they see some angels going really late, but broadly, I think sometimes they are talking to the wrong investors or especially VCs far too soon before they've got the right ingredients.
Yeah, I 100% believe that many founders talk to VCs too early in that very early stage. And I think partially that's the fault of VCs who say, yeah, we do early stuff, come and talk to us, build a relationship with them. But what I've seen is that in a lot of cases, the VC is judging the founder at that particular point in time. They're asking themselves is, would I invest in this? They're not necessarily asking themselves is, what would it need to look like in the future for this? And they take notes and they know exactly where the founder's at. And the founder, being the eternal optimist, has told them what they're going to do and deliver. And when they come back down the track, they haven't done what they said they were going to do, or it's taken them 3 or 4 or 5 times as long to achieve the metrics that they thought they were going to achieve, and they've automatically got across. I just think it's hard to unblock out from a VC perspective, just to not looking at this from an investment perspective.
Yeah, it's really interesting because I'm definitely one of those that says, come and talk to us early. What I have in mind, and I might be guilty of not actually being true to this, but what I have in mind is actually seeing the development of the founder over a period of time. What is their own personal delta and how have they grown through that experience? Not just what have they executed on? Because one thing we talk about a lot is how do you actually measure the founder's resilience, the founder's ability to behave differently in the same context when results aren't occurring. So that was the sort of data point in terms of getting to know founders early. But yeah, what you've said actually does challenge me a bit. It's actually, am I just prejudging founders? And yeah, maybe there's some bias in there I'm carrying that I'm not even aware of.
Yeah, I think I do it as well, right? When someone comes and pitches or having a conversation, I am thinking, would I invest in this and what it looks like? In fact, sometimes the best scenarios for me is I say to someone like, I am absolutely not investing in this, or I'm happy to have a meeting with you, but I'm telling you right now, I'm not going to invest. So I'm going to try to be brutally honest and give you feedback, sometimes things that you don't want to hear. I remember a couple of times I've had meetings with founders and I said to them, they went down to pitch a particular route and I said to them, look, I wouldn't say this, I wouldn't do this. I don't think this is actually right because I think it's getting people the wrong way. And his response to me was, that's really interesting. I've had this conversation with a number of people and I've had this uneasy feeling about something that I'm doing wrong, but no one has ever said what you just said. And now that I think about it, I think that is actually the problem of what it is. Now, he didn't have a solution for it, and I didn't have a solution for him at the time, but at least gave him something to go away and think about and actually come up with a better way of actually addressing the problem. Because he was actually creating a concern when he probably shouldn't have been creating that concern because he was talking about something that wasn't really as relevant at the time.
One of the things I see founders get a little bit wrong is that they try and do too much too early in the first pitch. My view is that the first pitch, and sometimes even the second, is not to get money, it's to get interest. But they try and shoehorn so much information that it just becomes confusing and overwhelming for the investor who's seeing a lot of deals each week. What's your view on that and the amount of information they should be sharing straight up?
Yeah, look, I agree with you in the sense that a lot of founders go into it thinking here's the pitch. At the end of the day, I'm going to do the first presentation and they're going to say, yes, I want to invest, or here's some money or whatever. Whereas it should be enough information to the person to say, that's interesting. I want to learn more. And almost like every conversation is a progress of that's still interesting. I want to learn more through that process. But again, it's a fine line depending on which investor you're talking to, because you go and deliver the same pitch to 5 different investors and you'll get 5 completely different experiences. And if you ask them all for feedback, you'll get 5 conflicting pieces of advice. So it's hard for the founder in that situation saying, which one do I actually do? And you've got to almost like filter down to try to understand where it actually is, right? Do you send someone the deck beforehand and then have a conversation? Because sometimes that's actually a much more valuable approach rather than talk through the deck.
With my experience with angel groups, if you don't have the exit slide, 50% of the room goes, they've got no respect for my money. They aren't telling me when I'm going to get back. So you put the exit slide in and then 50% of the room says, they're not concentrating on building a great business. They don't. So yeah, coming back to that empathy for founders, it's hard.
Yeah. And I think, so I completely agree with that, right? Because especially when you're pitching to an angel group or in a constrained, right? Sydney Angels, and I think Brisbane Angels does the same, like you do a 10-minute presentation and then you do 10 minutes of Q&A. There's a set format, right? So you've only got 10 minutes to get your initial information across. And that information has to be engaging enough for people to ask questions and actually learn more. Now, a founder should know that there are certain things that are going to be asked and you can't do all that stuff in 10 minutes. So you try to set it up so that you can talk about those things in the Q&A part of it. And I've seen a couple of founders say in their pitch deck, hey, we're going to get to talk about these 5 points. You might want to ask me about them on Q&A. And that's almost like their last slide that they leave up.
No,
and it's actually a really effective way of getting information across that you want to get across and telling people this is the kind of things you should be interested in.
I think that is a great idea. And one of the things that's normally towards the end of a pitch is the valuation and the use of funds. Where do you think founders go wrong understanding valuation in the minds of investors?
The vast majority of founders start with a valuation probably well above market, especially the earlier they're pitching in their pitching phase, the more risky it is, the more experience they've got pitching and getting feedback that starts to come into light. I think what founders don't realize is that in a lot of cases, valuation is a function of supply and demand. There's a huge amount of opportunities for investors out there. There are hundreds of startups looking to raise capital, and a founder thinks about their competition fundamentally as another company doing the same thing, not every single other company that's out there trying to raise capital at this particular point in time. And when you're raising capital, that's actually who the competition is. So you've got to get someone to say, I'm interested in learning more about you, and that money's finite and I can't invest in this other company. So why should I talk more to you and not that other company over there? And so I think if you automatically have a valuation number that's too high, it's just easy for an investor to go, not interested. It's going to be too hard to get that to a more realistic thing. Next, go to the next one. So I prefer founders to have a clear amount of quantum of dollars that they actually need in terms of what are they going to do with that. Less about where the dollars are going to be spent. So it's not about sales and marketing and this, but I also want to know what's going to be delivered as a result of those dollars. So what's the outcome I'm expecting and what kind of time frame? And then probably some kind of broad range, or the founder who says, I'm raising $500,000 and here's an indicative range, but it's not about maximizing the actual valuation outcome. It's about getting the right fair and equitable deal around it. And I've seen scenarios where people put a range in and everyone assumes that the investors are going to just skew right to the bottom, but they don't. If you spend the time with them and you've got a competitive process and it's a good deal, if you get too much demand at the bottom, you can put the price up.
I've seen it multiple
times. The economics.
Yep.
There's a good point in there about the competition. And also, like for us, one thing I'm really conscious of as well is our own timeline, our own stage of our own firm and the results we need to demonstrate, and for founders to be a bit more aware of the life stage of a fund, and it does influence the investment manager's decision ultimately. So I think they're really good points.
So it's one of the advantages that angels have, right? Because they don't have a capped end on the fund.
Yeah.
There's actually a strong alignment in a lot of cases. Now, it can mean you need much deeper pockets for a lot longer than what you thought going into it, but that's not necessarily a bad thing.
I have a Something that's been on my mind recently, I'm keen to see if you've seen something similar. By seeing founders that are well connected in an industry or a geographical region and they get really good traction out of the gates. But once it comes time to expand out of that region or that network has reached its cap, they struggle to build that scalable sales machine versus founders who are like, I did a recent trip up to Townsville and there were 4 companies up there just performing incredibly well. And I attribute part of it to the fact that from day one, they had to sell a region out of network. So they developed that expertise quite early. Do you have a similar observation at all? Have you come across that?
You definitely do see it, right? Where especially if they're deep in the industry and they're B2B, they've got connections and networks, they can get in that. Now, I think the thing you also need to balance out is somebody buying that because it is a strong personal relationship and they're doing a friend. Like, how do you make sure you get it beyond that normal kind of network and relationship? And sales and marketing is super hard. I think sales and marketing at the business level is changing. Like the whole outbound cold outreach stuff doesn't seem to be working anymore. And everyone is struggling with that and looking for new solutions. I'm not sure if that's geographic based, but I think that's across the board. But I think you're right. Is the smaller the market you're in, if you're going to build a proper business, you have to look further out, right? So there are a number of markets around the world. Like Australia's a big enough market that for most businesses, you can actually build a reasonable sized business in Australia without actually having to look outside of Australia. But you still want to go big. So you do that. Go to smaller markets, go to New Zealand, and New Zealand is a certain size and you want to go beyond that. So in a lot of cases, you can't just build a big business out of New Zealand market. So they have to look beyond. So quite often they look to Australia in the first instance, which means they actually start thinking outside of it. And I think the other market where it does this really well is the Israel ecosystem. They've also not got a big enough market in that to do it. So they build global from day one and they have a super strong tech background and a super strong discipline because of the military side of things that's come through as well. And I think they've got probably different risk tolerances than what a lot of other people do, given their military experience and the region they live in.
With that view to be building out of network, sometimes I think founders don't put enough effort into the investor comms during the journey. And one little call out is the worst thing you can do is not talk to investors, not explain where you're up to, try and hide the fact that things aren't on track. And then the next time the investor hears from you is, could I have some more money, please? It leaves just a real bad taste in the mouth. Now, the reality is because we've all got portfolios and sometimes founders look at their business and say, nobody else can be in such a problem state as I am. We assure you they are. And so actually, you're not going to be surprising us when you give us either monthly or quarterly updates that some things aren't on track. But I just can't reiterate enough. People that wait and only communicate when they need money tend to get themselves into a problem because where's that relationship? Why would we back you if we're not in the tent and the only time you want to talk is when you need more dollars?
Yeah, I think that's right. Getting investor updates out. They don't have to be war and peace, right? Just keeping regular contact.
One page it really doesn't have to, you don't have to overcomplicate it.
Yeah, I think a couple of key metrics are good, bad, ugly, or what are you asked? What do you need help with? Don, you're right. Everyone knows things aren't going right, but the entrepreneur wants to always put the positive spin on it. And what you then find is that they go, oh, this month's not quite right. This update's not quite right. I'll just wait until I fix this problem up so I can tell them about the problem and tell them how great it was that I actually fixed it. And if you're doing quarterly updates, what invariably happens is the quarterly update just doesn't go out. And then it's next quarter. And if you miss 2 of them, all of a sudden it's 9 months. And then given that most businesses need to raise capital when things don't go right, the first time you hear is, can I have some more?
I guess it's just the way that we're built from prior operators' side, and then we try and bring some tools and frameworks to help them with their problems. The only time you have no problems as a company is when you're dead. As long as you're alive, you're going to have problems. And then with growth, what growth actually means is faster and faster, more and more problems.
Yep.
So I just want to reiterate that. And sometimes I like doing my little memes on LinkedIn and socials, and every now and then founders will say, was that directed at me? Yeah. It's directed at all of you.
And as you get talking about problems, right? And as the bigger the business gets, the more people they have at the CEO level, all you get is problems. You're working on strategy stuff and problems because you'll get all the problems that somebody else can't solve. And if you're putting good good people in place, they can solve the easy problems. So you actually only get the hard problems. So the bigger you get, the harder it actually gets as well.
So true.
And you look back on the early phase saying, I wish I had those problems of a few years ago compared to the ones I've got today.
Yeah.
Oh, it's so true. But especially as a firm that we do want to get actively involved, but we want to hear the problems. It's almost when a friend doesn't tell you something that they've gone through, and then it makes you feel like your relationship isn't that strong because they didn't actually share their problems with you. We want to hear the problems.
I guess the core message I just really want founders to understand is that everybody's got the problems, and probably for investors as well. If you're new to this space and you think that there's a scenario where other investors have a portfolio that doesn't have as many problems as yours, it's just not true. And so what you've got to be able to do is you've got to help founders get a good perspective on problems and then create the culture and climate to resolve those problems. That's as most as you can do.
I think it's really interesting in the sense that the founders don't want to disappoint their investors. Right? I think that's where it actually comes from. So it actually comes from a good intention. But I think the other side of it's interesting is that we sit here and say, yes, tell us your problems, give us some stuff, and everyone says the same thing. But there's some underlying thing where founders aren't trusting to say, actually, you know what? Here are my problems. I'm happy to willing to share those problems. And I don't understand it. Like there's something that we as investors are doing that are actually contributing to this.
I sometimes go looking for patterns where no patterns exist. I appreciate that. But if you think of our schooling system and then even some parenting styles, anybody in a position of authority, since we've been born, problems are not actually celebrated through different phases of the life cycle and different parts of life. And so whether it's your parents jumping down your throat because of a problem, then you get to school with your teachers, I think actually it's just a continuation that we are built to have a negative reaction that if there's a problem, someone's going to come down on me. And I think we do a reasonable job with our portfolio because what we've started to do is our investment comes with a couple of strings. And one of them is we do a workshop within 4 weeks that just shows them how to get all of their problems on the table as a team. And then we've got a baseline. But even then, over time, it does creep in. I've just got to remind you, I'm not going to whip the shit out of you when this happens. That we just, if we can help, we'll help. So that's, I could be oversimplifying it. But there's shit that I sometimes will pause before I've told my wife I've done something incredibly dumb.
Do you share everything, Don?
Adrian. It's do as I say, not as I do. I'm mindful of time, and I could keep talking to Adrian till the cows come home because I think we're aligned on a whole lot of things. And Aaron, I think there's some things for us to reflect on, but we're coming up to 90 minutes. Adrian, is there anything else that you think in founders or even investors get wrong in the investment raising process?
Look, I think we've spoken for a while. I could probably talk for a while, and maybe there's another podcast at some point in time in the future, maybe not 5 months away, but a little bit faster to bounce through some other stuff. But no, look, I've really enjoyed the conversation. I think I've taken away some great stuff as well.
I appreciate it, and I look forward to, I think the last time, actually we was in Les's boardroom the last time I saw you face to face. I look forward to the next time. Aaron, anything else your end?
No, this has been good. Definitely a couple of points in there for me to reflect and think about, actually. So this has been awesome, Adrian. Appreciate it.
No problem. Thanks, guys.
Thank you.